Hello my fellow traders, this is Martin Jansen from Trade It Simple, and this is my outlook for the next trading year. Let's get right into it. Euro dollar. It has made the downside break from this massive triangle formation. The fundamental factors support more downside as well. First of all, the ECB's plan to start its QE program. We should get an update on that in the next ECB meeting on January 22nd. Secondly, the interest rate expectations. As you have probably heard, in the last Fed rate decision, Janet Yellen hinted that we could see the first rate hikes in about 3 months. So the technical break and the fundamental factors are pretty convincing for the more downside to come. I am looking at this massive falling channel formation, and my target for the next year is somewhere between 110 and 107.50. Can it go as low as parity? I mean, yeah, but it will take a lot of fundamental drive to get it down there. Alright, the next one. Pound dollar. I think this is going to be the year of dollar. I am also looking for more downside here as well. I am currently looking at this setup right here. A rising wedge formation after a very steep decline when the economic crisis started. If it breaks out from here, I would be looking at targets like 120 and 118. Again, is it going to reach these levels this year? It is too early to tell, but in case of a break of this support here, I would definitely be looking at least at the lows here at 135 to 140. Of course, we also have to look at possibility the Bank of England could become more hawkish. The first interest rate decision is already this week. For the past year it was a complete non-event, but more hawkish tone with updated rate forecasts would indicate the rate may be continuing trading inside the wedge range, and we could be heading up to 170. However, with the more hawkish tone, I would better play a stronger pound against euro. Let's take a look at this one. The rate has broken down from this triangle formation and is now testing the old support as the new resistance. I have already taken a short position from the top of the triangle, but if we see a rejection from these levels, I will be scaling back in this trade. We have to be careful though, because the rate is trading just above this important support at around 77.70. A break below this level and we could be looking for the triangle target here at around 75. Alright, let's move on. The Aussie dollar. The rate keeps trading lower, but we are now sitting at a major psychological level at just above 80. As you can see, it has been a level of interest in the past as well. I currently don't have any bias for the pair yet. We'll just have to wait and see. A rebound from this level should take the rate up to 86.60. A more serious retracement may push it up to 95 and maybe test the falling trend line around 97. If this breaks 80 level, I would probably take a small short position. However, we have a rising trend line dating back to 2001 coming in play at 73 to 75. In one word, the rate is now trading in the middle of the range and it is difficult to predict the next big move. One very interesting pair I'm monitoring closely is EURAUD. It has been raging for the past year, but now is forming a potential head and shoulders pattern. This is actually my top trade for 2015. With all the Eurozone's problems, I'm targeting 140 and 122 levels. The best thing about this trade is not only the potential huge move to the downside, but also that it acts as a carry trade as well. The next one is dollar yen. I think it may be a boring start of the year for this pair. Take a look how it has performed in the past. A huge move to the upside and a congestion pattern. A breakout, move to the upside and a congestion pattern. A breakout, move to the upside, and this is where we are right now. Another thing that signals we may be consolidating is this trend line right here. Yes, a break to the upside and I would be happy to buy the pair, but consider another factor. the risk aversion theme. The Fed raising rates could and should spark a risk aversion theme in the equity market. And you know, in market conditions like this, investors are going for safe haven assets, and yen tends to outperform all the others. The last pair we are going to look at today is Kiwi dollar. The rate is currently sitting at important support level at 77. The same as with Aussie, it is very difficult to predict the direction which the next move will be. I think this may turn out to be purely about interest rate expectations. The RBNZ has already mentioned the future rate hikes. However, as the Fed starts to normalize the monetary policy, and overall dollar strength may take the rate further down. There are, however, plenty of support levels that could stop the rate and turn it around. 75, 70, 60, and plenty more. So that was my outlook for the year. I wish you many pips and great trading year. As always, if you have any questions, leave them in the comments below.